I am Brian Klinksiek, the Global Head of Research and Strategy for LaSalle Investment Management. What we generally see in real estate conditions today is some short-term softness in the sectors that had been the favored sectors or the strongest sectors for the last several years. So there's a wave of supply that's impacted global logistics markets, a wave of supply that's impacted U.S. Apartment sector dynamics, particularly in those high migration Sunbelt geographies. And so the short-term prospects of the sheds and beds space are actually less positive than they had been for quite some while. That softness won't be forever. We see that already starting new development projects has fallen substantially. So completions remain high, but that takes time to filter through. In the shorter term, the most stable conditions that we see in fundamentals are actually in some of the sectors that have been very much out of favor, like retail. So retail, we say, is back on the investment menu. It's shown to be the most resilient and actually the highest returning in some parts of the world in recent history. And then we see continued strength in many of the niche and alternative sectors across the geographies where we invest. We've been recently in very much a period where office has been off the menu in many geographies. It's been seen to be very unattractive, correctly seen to be very unattractive. But office occupier conditions in terms of taking new space are about to become more aligned with the growth in office employment. Those two lines, the trends of job creation and office space demand, used to be highly correlated. And that broke down with COVID, with work from home, less space per worker. We see the beginning of those realigning in the US, which means that demand on a net basis should come back. And so this is a reminder that office, while it had been kind of off the menu, should not be permanently off the menu. And it's a meaningful part of the investable universe for real estate and an important part of portfolios. Perhaps nowhere near the levels, the allocation that it had been in the past. So for diversification, we're sort of entering a stage of everyone wanting logistics and residential to one where more sectors are attractive and investable. The investors need to think about what is the long-term allocation that's aligned with the kind of share of these sectors and their relevance in the broader economy. So for those out of favor sectors, it's not zero, but it's something. And so thinking about diversification, you really have to look at that broader set of opportunity. In thinking through that, we recommend looking at a fair and relative value framework for kind of understanding what is attractively priced today and what isn't. But it's no longer just the simple story of buy more sheds, buy more beds. So we have a couple of thoughts about how to think of political and geopolitical risk. The first one is avoid overreaction. You saw that in the wake of the US presidential election, which was a surprise, not in that Trump won, but in that he also, the Republicans got a full sweep of the House and the Senate. That was a surprise. The markets really reacted to that at first and said, we're going to have more growth, more inflation, and higher rates. But by the end of election week, the 10-year Treasury was actually down by 10 basis points. And so I think the first caution is that it says don't overreact to news flow, and that we saw a slide today by Jim Costello from MSCI of how real estate has returns over long periods of time haven't actually reacted that much to who's the president in the US. So first is don't overreact. Our next suggestion is to think about local politics as well. The media news cycle tends to focus on big picture stories around presidents, but for real estate, it's a local business. And what's happening in local planning policies, local leadership, the ability of places to deal with local issues around transportation, crime, getting in housing, all of that happens at a much smaller scale, and you have to be granular in thinking about that. And I think the third caution is the big scary stuff geopolitically, don't sweat that stuff, because there's very little that you can do to predict that accurately. And even if you could predict that, it'd be very hard to understand what assets would perform and underperform in that world. So focus more on incremental changes rather than the big scary stuff that's low probability but high impact, that's sort of hard to predict. We see good opportunities across many of the geographies where we invest. The US story is really one about the fundamental economic growth and health of the US economy. It is likely to get a bit of a boost to growth from cutting some of the regulation and red tape, which is likely under the new leadership. European growth, by contrast, especially in aggregate and especially in Germany, is not attractive. But the real estate fundamental story is especially attractive because you don't have quite the same wave of supply issues that's impacting short-term fundamentals in some sectors in the US. Office is in a much better position in Europe. So they're both attractive, but sort of for different reasons. Europe, because it's heavily repriced and the fundamentals are strong. The GDP isn't growing. The US, because it's very dynamic with growth. And then in Asia, I would really highlight the fundamental strength of Japan. Japan is the odd one out from a monetary policy perspective. It's tightening gradually, but that's more a part of a normalization of the Japanese economy. It's more of a feature, not a bug, of what's happening there. But one of the things we like about Japan is it's liquid, it's deep and investable, but there's so many inefficiencies that an investor can take advantage of to operate real estate there in a more modern way. So it's unusual to have a big, developed, dynamic country in this deep market that's also kind of riddled with lower hanging fruit to operate real estate better.